Well, the dollar broke out to the downside last week, touching its lowest level since the first quarter of last year, with cooler than expected inflation data the trigger, sparking a dovish repricing of longer run Fed expectations, allowing equities to rally and treasuries to find demand as well, with yields coming lower across the curve. A quieter week lies ahead this week, leaving markets with the question of whether they consolidate last week's moves or continue them. But traders are already starting to look into the future with an eye on the FOMC, the ECB, and the Bank of Japan at the end of this month. It's another busy episode of The Trade-Off this week, so without further ado, let's get into the show. Well, it only took 2 attempts to record the intro to the show this week, so things can only go up from here. Without further ado, let's bring in my co-host, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, I hope at least one of us can make sense of things on the show this week, because I'm having a bit of difficulty at seats at the moment.
Well, you're lucky it's only Monday, so you're right, things can only get better, or they could get worse. So with that pressure in mind, on you go.
Well, I was going to say, things may indeed get worse. The fourth test starts on Wednesday, doesn't it? So I'm not holding out too much hope that things are going to get much better as the week progresses. But before the show descends into a debate about cricket, let's get on to topical thunder. So I want to talk about the FX market first of all. We saw some nice breakouts across the board last week. I think it was either last week or the week before I was saying that the G10 FX space just seemed a little bit quiet. Volatility had come quite significantly lower. It felt like sort of true and proper summer market vibes were upon us, but that suddenly last week was not the case, with the dollar breaking sharply to the downside of its year-to-date range. And both Ryan and I have got some charts on that we can talk to momentarily. But as I said in the introduction to the show, it was the cooler than expected CPI figures. Headline CPI rising 3% year on year, the core number at 4.8% year on year. That kick-started a dovish repricing in terms of the longer run Fed outlook. The market still sees a July hike as nailed on, but now pricing in as many as two 25 basis point rate cuts in the first half of next year, compared to not even pricing one of those cuts around about a week ago. And we saw some quite big levels breaking across the FX leaderboard. Cable trading north of 130, the euro above 110, 111, and 112. Dollar yen coming back below 140, and of course the dollar index coming back under 100. So I guess the question that I've got for you, Ryan, and I know which side of this particular fence I come down on, is do we rebound in this week, or is the bearish dollar trend going to continue its momentum? And personally, given the lack of catalysts and this kind of waiting game we're playing until the next Fed, it does look, for me at least, as if the path of least resistance is, for now, pointing lower for the greenback.
Yeah, I think you're right. I think you did well to give it the kiss of death by saying how low FX volatility was, and that woke everyone up, which is good for us traders. Yeah, I think you're right. We have seen a big repricing. A lot of those central bank expectations washing out, which we've been saying they've been getting far too extreme anyway. I think you're right that the dollar is perhaps on its way lower. It's not going to go in a straight line, of course. We may get a little bit of sideways action now. We're creeping towards the Fed, but we've got this week to get through yet. We've got some key pieces of data coming out, retail sales from the US tomorrow. So, as we always say, the trend is your friend, and we've had a big, strong trend in pairs like dollar yen, and now we're seeing a bit of a pullback, and that's lasted a couple of weeks. So you've got to look at your key levels, you've got to check your charts, and the price action will tell you all.
Yes, absolutely. And I think I saw a few pieces doing the rounds last week, both in terms of sell side and also in terms of financial media, talking about the everything rally. Equities higher, bonds higher, crude higher, gold higher. Well, what's the other side of that? Well, it is a weaker dollar. So if we do see that positive momentum continue pretty much everywhere else, then, not everything can go up in a straight line at the same time. And it does seem that the weaker dollar is going to be that kind of pressure valve that allows everything else to continue gaining ground, if indeed that is to prove to be the case. But of course, we do have that Fed meeting on the 26th of July, as you rightly mentioned, the ECB and the Bank of Japan in the couple of days after that. And you've got to question, if we do see these moves continue, does the market get a bit of a rude awakening and a reality check from Chair Powell in about 10 days' time at his press conference?
Yeah, exactly that. And I think that is the big risk for the dollar at the moment. We've spoken about it time and time again. The Fed message is to keep rates higher for longer. They want the tightening financial conditions to stay in the market. They don't want the market undoing all that. So I think the big risk for dollar bears right now, and we've got some time till next week, is in fact the Fed coming out in those meetings and the ECB and reinforcing their higher for longer stance and saying don't get too eager for cuts or taking down financial conditions just yet.
Yes, absolutely that. But let's not steal our own thunder and use up all our material for next week now. So why don't we get on to some of the data that we got coming up this week rather than next week?
Yeah, well, last week we asked the question, whether the CPI and the rest would clear things up or muddy the waters further. And muddy it was. We've just been discussing about the price moves. We saw CPI, PPI, further drops. But then on Friday, we got a bonanza Michigan consumer sentiment report. And, then the market's going the other way again. Now, what's happened really is that, as Michael explained, the market has really drawn down Fed expectations after the CPI and PPI. Second hike is all but priced out. July we're getting one. Then what will happen after that? And as Michael said, we're pricing in cuts for 2024. This week we have US retail sales. That kicks off tomorrow, not long after this show. And then as far as this show is concerned, we've had the Empire Manufacturing, which has shown a little bit of an improvement, not a huge one, but it's a sector we know is already down in the dumps. So we'll keep an eye on that data today. Empire is already out, as mentioned. Billy Fed is on Thursday. Mm-hmm. But overall, the US fundamentals continue to point to a soft landing. And, you've got to ask, is this scenario real or is it too good to be true? Because we really haven't felt the bite from the Fed hike cycle yet. So I'm thinking, Michael, maybe this is too good to be true. What about yourself?
Yeah, I like to be pessimistic. So, I think I would probably come down on that side of the argument as well. As you rightly say, everything is pointing to a soft landing at the moment. If you look at the data we had last week, CPI coming in cooler than expected with a 3 handle on the headline number, PPI falling to quite a chunky fall compared to the prior print and almost in deflationary territory on the goods side of things. Jobless claims coming down. I think the initial number was 237, 239, something like that last Thursday. So that's pretty good. Everything is pointing, and of course the payrolls data that you had a week prior to that, which was also pointing to a continued resilience in the labour market. Everything seems to continue pointing towards the US economy just ticking along okay at the moment. And as you say, the impact of all that tightening just doesn't seem to have been felt at the moment. Yes, you've got ongoing softness in the manufacturing sector, but that seems to be a global phenomenon rather than everything. I guess there's 2 areas of concern that I have. The first is on inflation. Well, they're both on inflation. The first is the split when it comes to inflation. I think we can pretty safely say that inflation in terms of goods is quote unquote solved. You look at the PPI number, you look at commodity prices, everything, supply chains easing, everything there seems to point to goods inflation having a big green tick in the box and saying that's done and dusted. Services inflation is a different story. There's still intense upward pressure on earnings. There's still a lot of price pressure coming through in the services sector, which I think is going to worry policymakers. And the other point I would make is that actually you've got quite a favourable base effect, which is dragging the inflation numbers lower, particularly the CPI number. Obviously, you're comparing prices in June 2023 to where they were in June 2022. And that base effect becomes less favourable as we move through the year. And even now, if you start to take a 3-month average of inflation data on a monthly basis and annualize it, particularly at a core level, there hasn't been that much progress made over the last kind of 6 to 9 months. So I do think that there could still be something of a sting in the tail of all of this, and certainly there's enough in there, as you alluded to, for the Fed to maintain this higher for longer stance for the foreseeable future.
Yeah, most definitely. But everyone's coming out. I think it was the IMF that said, they see a peak in inflation now. You look at US inflation, it's been dropping for the last 12 months. So I'm not sure when why they're seeing a peak only now. But you're right, there is some base effects in there. But the trend is your friend, as we often repeat. And for now, CPI keeps coming down. It's only when it turns are the Fed going to have a problem.
Absolutely. The other thing I would ask is when were the IMF last right about anything? But that's probably a conversation for another day. I mean, on that note, I saw the OBR here in the UK were trying to forecast UK growth out to 2060 or something last week, which, I mean, they couldn't tell you what's happening today, let alone what's happening in 50 years' time. But I digress. I do want to talk about the UK, though, because I said last week that it was a big week here in the UK for economic data. It is another big week for economic data here in the UK this week, and I feel like I might use this subject next week as well, with the PMI data due out on I think Monday or Tuesday. Last week it was the turn of employment, and the jobs data was not great, let's be honest. Unemployment rising to 4% in the 3 months to May. Of course, the UK data for jobs is slightly lagging. And earnings rising 7.3% year on year, which equals the record pace that we saw during the pandemic. And of course, you've got to remember, during COVID, the earnings data was very, very distorted because you had job losses disproportionately affecting those on lower incomes, which kind of had the impact of skewing overall earnings growth higher. So this, you could argue, is a slightly truer reflection of average earnings and a real record pace. But of course, given that inflation is still at 8.7% here in the UK, real wage growth is still negative. And actually, when you start to dig into the data a little bit more, you do start to see that actually all is not quite as rosy as that would sort of suggest. You know, firstly, it is running the risk of a wage price spiral developing, and secondly, those wage rises are concentrated among the higher earning deciles and higher earning sectors. So, for instance, earnings in financial services, according to the ONS, rose by 9% year on year in the 3 months to May. Now, I may call them up and have a steward's inquiry over that one, but I think it does point to the fact that this is not something that's being spread evenly across all areas of the economy. Now, of course, all eyes this week shift to inflation. The market continues to price around about 43, 44 basis points worth of tightening for the next BOE decision on the 3rd of August. We're expecting a further fall in headline inflation. That's likely to come down to 8.2% from 8.7% prior. This data is for June, but again, there's a big impact of, firstly, energy prices coming lower, and secondly, those base effects that we mentioned in terms of the US, they are also helping things out here in the UK and bringing the year-on-year comparison lower. I think the bigger concern, and what should be a bigger focus for financial markets, is the core inflation number. That's expected to remain unchanged to the 30-year high of 7.1% year on year. And that's the real concern. That's the real kind of stickiness in terms of price pressures that we see coming through into the UK economy. And I just wonder, Ryan, I think going into the inflation data, the risks for UK rates and the risks for sterling are probably a bit asymmetric. I mean, I kind of question how much more aggressive the market could get in terms of terminal pricing for the BOE, given that we already see terminal priced at 6.5%. But if we see a cooler than expected print, I think there's quite a lot of room for a repricing in a more dovish direction.
Yeah, that's been my thought for several weeks now. And yeah, the market has been getting extreme in its pricing. The data, I'm not sure about this print. I think we could see stickiness prevailing here. We did get, as you said, an energy price cut for households, but that didn't kick into July. So we're unlikely to see that filtering through into anything at the moment. That's why I expect maybe from next month's readings, at least the start of it, that's when the Bank of England might start getting the numbers coming their way. I think core, like we've seen everywhere else, is still going to remain sticky. Still got a lot of wage hike prices coming into it, including those public sector wages now fixed at 6%, and still some disputes going on, train drivers, NHS consultants not happy with the pay deal. So there's still rumblings of that to come through. But I think, we're likely to see a bit of a dive on the energy front from next month, and still sticky from the core. But you're right, if you do see both numbers dipping down, that's going to pull back expectations a bit further for the Bank of England. I think a 50 pip hike that some are expecting is again to the extreme side. If they do that, then I expect to see a pause after that. But as I say, they may get the clock might be on their side for this one if they do start seeing inflation pulling back in the latter part of the year.
Yes, and just to add a bit of context to the inflation data, the way the calendar has fallen is that this is actually the last inflation read the BOE will get before their next decision, which comes on the 3rd of August. So, we had employment last week, we've got inflation this week. As I said, we've got the PMIs early next week, and then that's kind of all of the data that the BOE are going to have in the pot to then go and discuss policy for the decision on the 3rd of August. So I do think that we may see those expectations kind of bed in and really start to settle down after the inflation data on Wednesday. And then, as you say, we get into this kind of interesting period where the market could be pricing in 70, 80, 90% chance of a 50 basis point move, but the BOE go for a much smaller than expected hike. So be interesting to see how that one pans out in a couple of weeks' time.
Yeah, definitely. And don't forget, we've got retail sales on Friday as well. So we get to have a look at whether Kyriakos has bought that new mic for you or not.
Having seen the price of that new mic, I think that could add a good couple of percentage points to retail sales on its own.
And inflation, yeah,
definitely. What about the Treasury market, Ryan? Some interesting themes panning out there.
Yeah, so looking at yields as one has to do when talking about rates, and one standout theme we really need to pay attention to, and this is something that Blake touched on in the Trade Off Australia, was the possibility of some investors looking to lock in yields on a perceived top in interest rates. 2 weeks ago, we saw US yields rising to 4.09%. UK 10s were running up to 4.7%. But pretty much right after filming that last week, yields collapsed right back down. And a lot of the data then suggested that the market is finally coming around to the fact that central bank rate hikes might be at the end of the road. And thus, obvious decision to make is that the next rate move is likely down. So in that scenario, investors have a choice to make. They can continue playing rate trades like carry trades in FX on the rate differentials, which may start paying less if the next move down in interest rates, or next move in interest rates is down. Or they can move into bonds where they can lock in a high yield and sit on that for potentially years. So I think given the moves in yields last week, there's a big part of me that's saying that's exactly what investors have started to do, move out of some of the other assets into fixed income where they can sit on those trades. I think you made the point, for a lot of them, their capital gains free or tax-free, particularly in the UK. But for the central banks concerned, like the Fed, ECB, Bank of England, they will be looking closely at those moves, because what these moves can do is loosen those financial conditions more than they'll want. And they won't want their higher for longer message to be put under pressure once again by the pivoters. So I suspect there's going to be yet another round of concerted efforts from central banks to drive the hawkish message home, the higher for longer message home, just to keep the market from getting too far running to the other side of the boat.
Yeah, absolutely. I mean, it's a really interesting one. And actually, you then start to think about, the implications of this for other asset classes. So you look at, what the 2-year Treasury, for instance, now is what, 4.75, 4.6-ish at the time that we're recording this. If you're an institutional investor and you can get 4, 5, even 6% in relatively short-end debt, why would you push yourself further out on the risk curve into things like equities and into things like commodities when you can actually just get the same return increase certainty by just sitting there and collecting the yield on whatever you've bought. So, it is a very interesting theme, not just from what a central bank's going to do in terms of the potential loosening of financial conditions, but also in terms of the implications that has for markets more broadly. I mean, I think the FT had a chart a while ago saying that the S&P earnings yield, the 2-year Treasury yield, and the yield on short-term commercial paper is all pretty much equal to each other at this point. So if you're managing a sizable portfolio, primarily if you're looking at income rather than growth, of course, why would you not just go for the most risk-averse option? And that's then something for the equity bears out there to consider, perhaps.
Yeah, and as traders, you've got to understand, when we're talking about the wider market, the bigger market, or the non-retail market, there's a lot of money. There's lots of money flowing through daily. And some investors, passive investors, they'll jump ship for 10 basis points difference in yield, if that gets them 10 basis points. Because that 10 basis points on 10 million, 50 million, 100 million is a lot of money, compared to what we see it as. So when you get a big shift in yields and a big differential between something like, say, equities or bonds, then you're going to see a big flow happening by big money. And that has the knock-on effects, obviously, to what we trade in FX markets and all the rest.
Yes, absolutely. Right. Well, that has set the world to rights somewhat. So let's get on to some charts. That intro sequence seems to go on for longer every week. It's getting ridiculous. Right, I want to start with the dollar. Someone moaned at me the other week. I can't remember who it was now.
Someone moaned at you? No, I don't believe that.
Reversal. Probably some muppet on Twitter somewhere saying I had too many lines on my charts. Well, whoever you are, I can't remember who you are, but this is for you. A grand total of 1 line on the first chart this week. And sometimes it is one of those where, simplicity is best. The line that you see on there is 100.85, which was the prior year-to-date low for the dollar index. And of course, the usual caveat that this is weighted about 60% towards the euro applies. But that was the bottom of the range. And as you can see, we tested it 2 or 3 times prior to last week. And then all of a sudden, we get the softer than expected inflation data, and bang, we're through it like a hot knife slicing through butter. And I think it just proves that kind of rule of thumb that we all know and love, that the longer a market consolidates, the longer a level is respected, the more times a level is tested, the more explosive and more significant a break of that level eventually ends up proving. And so we've seen, obviously, coming from 100.85 all the way down to a low of around 99.5 last week. On a purely technical basis, if you look at the chart, and I haven't done it here because it would get a little bit too small, but you can zoom out on your own charts and you'll see that the next real support to the downside probably doesn't come in until the Q1 22 lows, which are around 97.75, which, although I think it might be a bit of a stretch to get there this week, I think that's certainly a level that dollar bears are going to be having on their radars. And I guess there's a couple of questions, really. The first is, if we get back to that 100 figure, which is not necessarily a technical level, but it's a psychologically important level nonetheless, how does price react? And then the second is, if we test 100.85 to the upside, which is now, of course, resistance, support turned resistance, how does price react? We've got a quiet economic calendar. It goes back to that question I posed earlier. Does the market extend those moves, or does the market merely consolidate them in the week ahead?
Yeah, I agree with that. And I think consolidation is what I'll be looking for from this one. We've had a bit of a blow-off move. Nothing, as we've said, keep repeating, nothing goes in a straight line forever. So no surprise to see a bit of a bounce. And what that does is it sets up your trading ranges. We've got that break of the 180.85 area. That's your resistance point, pure and simple. Your support point is now the low that we've made. If you start seeing higher lows get put in, you're going to get a move higher. If we start seeing further lows, even by a few pips, the move's not done, and there's every chance that we can keep going. So for once, technical simplification from you, Michael, but it must be me, because I'm sure I can see 4 lines on your chart if you include those moving averages.
Well, yeah, okay, 4. You've got me on a technicality. Fine, I'll let you have that one. Right, dollar yen. Now, having seen your notes for this, I'm just off to make a cup of tea, and I'll come back in about 5 minutes.
Well, it could be worse. We could be talking about the S&P again, but we're not. So you keep pulling, but you pulled me up on Twitter the other day for a war and peace tweet that I put up on dollar yen. But you've got to give the viewers all the information they need to make decisions in this day and age in these markets. So anyway, you go make your cup of tea. I'll have 2 sugars,
I'll be
please.
back in a minute.
Yeah, cool. And here's 600 pips sell off last week. The 145 level we've been highlighting before the move up, that held solid. And it's been quite some pullback. There's been several factors behind the move. Stock sales in Japan for dividend payments leading to the Nikkei coming off. Some Japanese data has been looking a bit weaker than expected over the last couple of weeks. A reduction in these Fed rate expectations. Also some rising expectations about the Bank of Japan tweaking at their next meeting in 2 weeks. So it was really one-way traffic for most of last week. But Friday gave us a bit of an indication that whatever was being repriced or traded perhaps came to an end. We had what looks like a bit of an overextension move during Asia trading on Friday, took us down to the lows in the 137s, 137.20s. But from there, we had a pretty big bounce up, back up through 138. But however, 139 was a decent level on the way down, and bar a Michigan-induced pop above Friday afternoon, we struggled to break it, and we closed the week under it. So on the technical front, while we stay below 139, the sellers keep the upper hand, which means we may get to test the downside again. I would suspect that those 137.20 lows will mark a bit of a bottom, but I want confirmation before I trust that thought completely. But what has been stark is the lack of BOJ speakers recently. And that's even as the market gets more tweak expectant. You can hashtag that one as well, Michael. Stick that on the payment list. 2 weeks before the June meeting, they came out quite strongly to quash rising expectations for that one, but they've been radio silent for this one. So, is that a sign of possible action at the next meeting?
Yes, I'm not going to say anything actually on dollar yen because I've got it down as my play of the day later. So I'm going to cover plenty. I say plenty. I'm certainly not going to cover as much as you just covered there. Brilliantly, I must say. But I will say my own 2 penneth worth a little bit later on. So let's get on to WTI Crude. Not one that I would throw into the show too often, but it is interesting because we had a couple of weeks where crude rallied pretty nicely. We had the Saudis coming out and saying they were going to extend their million barrel per day output cut into the month of August. Russia were going to do 500,000 barrels per day, and it looked to have, I think, at the third or maybe even fourth time of asking, finally had the desired effect and kick-started a more prolonged rally in price. We had sort of 10 days or 2 weeks of solid upside, but that really ran out of steam on Friday. We ran into effectively a brick wall in the form of the 200-day moving average. You can see that when we last tested the 200-day back in sort of April, May, we've backed away from that very, very quickly indeed. And it seems like we've done so once again in early trade at the start of this week. And I see a lot of people are pinning this on the poorer than expected GDP data out of China. Of course, the usual caveats around that data being entirely made up do apply, but the price doesn't lie, and we've broken below the downside of this bullish channel that's been running things for the last fortnight or so. Initial support probably comes in around 73.75. That is where we have the 100-day moving average and also the prior high sitting in there as well. And then, of course, you've got the 71.45 level with the 50-day moving average below that if we were to see further downside. And actually, I like playing this from the short side for now. I think that 200-day has marked itself out as very, very stiff resistance now. And from the more fundamental side of things, I think we do need to see a sustained pickup in demand in order to spark a more durable rally. And given the manufacturing data that we've got coming in, which is pretty poor, and sentiment around the global economy, which, the US looks like it's heading for a soft landing, but few other places do, I think that could be some way off for now.
Yeah, and the demand picture has been strange. We've had these production cuts, but, why is it kept rallying? We've had these production cuts going on throughout the year, so it was a bit strange, this rally, but market's going to do what the market's going to do. I'm going to be on the other side of this one. I was hovering over whether doing this as my play of the day today, maybe with a little long, testing I've got a little broken zone around a 73.30 down to sort of 72.20s, bit of a dollar, $1 range there. And that was a bit of a break point. So if you want to test this rally, that's a sort of area I'll be looking at to maybe pick some up. You can keep a stop fairly tight below $72. And if this move is a true move, then you're going to get a bit of a bounce up. And should the manufacturing data turn for the better, then that's going to be a secondary win for oil.
Well, there you go. As they say, it takes two to make a market, doesn't it?
Two to make a market. It does indeed.
What about the pound? Do we have to talk about the pound?
Yes, we do have to talk about the pound. It's very important we talk about the pound. Just because you want to sell it. Well, I'm actually on the same side as you for once. So, I know the cable last week didn't happen for you, which is unfortunate. But that's why we trade with stops. And I've been keeping a close watch on this pair, and it's really been about an itch for me, getting an itch to scratch regarding Bank of England expectations. Really getting into overzealous levels. And I've spoken often about this 85 zone as a potential strong technical support area. And I've got a chance to test that last week, with longs, which I'm still in. I did think there was a possibility of a move through the level on further rate hike expectations. But now we've had a bit of heat coming out of those last week, largely led by what's gone on with the Fed. I'm going to see if I can hold this position for a bit longer, because I think maybe this 85 level is going to be a bit more solid now that we've had a bit of cooling in those expectations. We do have CPI, PPI data from the UK on Wednesday, retail sales on Friday. So we may be on for another move back there if the data is stronger than expected. But if we can't break that level on stronger data, and you can take that for cable at its highs, any pound pair that's at a high or a low. If we can't break it on stronger data, that will prove, to me at least, that we found a bit of a top or bottom. And for the euro sterling, we found a good support zone, and I'll have greater conviction of increasing longs into that one.
Yeah, I think all is going to become clear after the inflation data on Wednesday. And I wouldn't be certainly on a short-term basis at least, I wouldn't be overly comfortable taking any sterling exposure going into that print. But as you rightly say, if we do get a hotter than expected number and sterling can't gain ground on that, then I think that is going to speak volumes about the near-term direction of the pound, and that's pretty much across the board. And as we alluded to earlier on, it does feel as if the risk is very asymmetric. Markets are already pricing in a very aggressive path from the Bank of England, taking bank rate well north of 6%. And if it feels like it would be a struggle to price in anything more aggressive than that, but pricing in something a little bit more dovish and a little bit more cautious should be comparatively easy on an inflation number that comes in even marginally softer than expected.
Yeah, markets and trading is all about patterns. I mean, we saw a similar pattern with the US dollar. Now, we had the good, strong ISM numbers. We had the good, strong NFP numbers. The market rallied initially on the announcements when those came out, but then we saw a big sell-off afterwards. The market had priced what it had wanted to price, and I'm looking for a similar reaction here. So good UK data, strong inflation, but failing to make any further gains in the pound.
Yes, exactly that. Right, let's get on to our plays of the day. Yes, so as promised, I'm going to talk about dollar yen. As Ryan said, the cable hopelessly wrong last week yet again. I think that trade is so far underwater at this point that it's barely visible, and I'm certainly barely visible. So let's see if we can do any better this week. As Ryan just alluded to, we had a massive move in dollar yen, not just last week, but also the tail end of the week before. I mean, that's 8 big figures from high to low, from 147 down to the 145 down to the 137 figure. And it feels like a little bit of a blow off bottom that we made on Friday. We had that big move lower, testing 137, the 100-day moving average, the 200-day moving average as well. And then we came back, and the buyers stepped in very, very quickly to drive the price to a close north of 138, quite a significant intraday intraday reversal. And it feels like dollar yen has priced in a lot at this point and also flushed out a lot in terms of long positions and also perhaps even those that were holding long dollar yen as a carry trade. And if you think about what's been priced in, yields have started to stabilize a little bit in the United States. It is a bit of a quieter week in terms of economic data. BOJ, Ministry of Finance intervention seems like it's off the cards for now, given the rally in the yen that we've had. And in terms of the BOJ, which is not this Friday, but next Friday, the market seems now to be expecting some tweaks to yield curve control. It's also expecting a fairly chunky upgrade to year-ahead inflation expectations as well. So taking all of that into account, I'm happy to just start playing the range here. 137.5 to 141 seems like where we could be until the Fed next week. That seems to have marked itself out pretty solidly, and I'm happy to, buy in at the bottom of that range and sell rallies if they get to the top of it for now. Ryan, what about Walmart? A little bit of a rogue one.
Yeah, Walmart, a bit left field, but something I'm looking at potentially some shorting some retail pain. We've got US retail sales, as I said, after this show airs on Tuesday. I think there's a chance we're about to see some pain for the US consumer. It may not come from this report, but I'm seeing some worrying signals about the future, especially from the drawdown in US savings. Walmart doesn't report until August, but I think generally the retail sector for Q2 should look okay based on past data. But trading is about what may come more than what's been. So if we're going to see a bit of a rate hike bite coming for the consumer, they're going to feel it first. So shorting a big retailer makes sense to me. I'd look at shorting this one at market where we are now, run a stop above the April highs in the 160.60s, and you can ride this one hopefully through this Q2 earnings and maybe into the August earnings, but you'll get those retail sales out the way as well.
Well, let's see what happens with that one. On earnings, it is another busy week of earnings coming up. I think, 60 of the S&P 500 report, Goldman, Morgan Stanley, Tesla, of course, IBM, a few biggies in there, mainly on Wednesday after the close. So do keep an eye on that if you've got any US equity exposure. Well, anyway, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. Us three will all be back this time next week. If you enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and if there's anything you want us to cover in next week's show, and we will see you again then. Thanks as always for watching, and goodbye for now.